War has a financial velocity. It is not the same as military velocity. The speed at which aircraft reach targets, missiles reach terminals, or ground forces reach objectives. Financial velocity is the speed at which the economic consequences of a military decision propagate through the interconnected systems of global trade, energy markets, insurance architecture, and consumer prices. Military velocity is measured in minutes and hours. Financial velocity, in conflicts of this geography and scale, is measured in the same unit, because the systems it moves through are automated, globally networked, and operate without the friction of human deliberation. Operation Epic Fury launched in the early hours of February 28, 2026. By the morning of March 2nd, 72 hours later, Brent crude had spiked 9% to $79 per barrel, with forward guidance from 3 of the world's largest energy trading desks, warning of $100 per barrel if the Strait of Hormuz remained operationally closed. 4 commercial tankers had been struck by munitions, whose origin and attribution were still being assessed by maritime intelligence firms. The war risk insurance framework for the Persian Gulf and the Strait of Hormuz had been withdrawn by Lloyd's and the International Group of Protection and Indemnity Clubs simultaneously. Hundreds of commercial vessels, crude carriers, product tankers, LNG carriers, bulk cargo ships, were drifting in holding patterns in the Gulf of Oman, legally unable to proceed and commercially unable to divert. Suspended in a maritime limbo created not by any physical barrier, but by the collapse of the legal and financial architecture that commercial shipping requires to operate. And the first confirmed U.S. military casualties of the operation had been reported from a base in Kuwait, a data point whose economic significance extends far beyond the immediate human cost, into the actuarial and political calculations that determine how long a military operation of this scale can sustain domestic political support. 72 hours. The question this analysis addresses is not whether the military objectives of Operation Epic Fury were achieved, or whether the strategic calculus that produced the decision to launch was sound. Those are questions for different forums. The question here is precise and financial. What does 72 hours of this conflict cost the global economy? How does that cost distribute across different economic actors? And what does the trajectory of cost accumulation suggest about the economic sustainability of the conditions now established in the Persian Gulf? To track the real-time macroeconomic fallout of global conflicts, the insurance mechanisms, the supply chain ruptures, the inflation transmission pathways, make sure you are subscribed to this intelligence feed. Now let's calculate the true cost of a closed Gulf. The first signal that financial analysts and maritime intelligence firms were tracking in the 72 hours following the launch of Operation Epic Fury was not the oil price. It was the tanker strike data. Maritime intelligence platform Windward, which aggregates AIS transponder data, satellite imagery, and Port Authority communications to provide real-time visibility into global shipping movements, began registering anomalies in Persian Gulf vessel tracking within hours of the first strikes. The MKD Viam, a very large crude carrier operating under a Marshall Islands flag with a cargo of approximately 2 million barrels of Saudi crude bound for South Korean delivery, reported a hull breach consistent with munitions impact at a position approximately 40 nautical miles southeast of the Qatari coastline. The Skylight, a Liberian-flagged product tanker carrying refined fuel oil on a UAE to India route, reported fire aboard its aft section following an incident whose cause was listed in initial Coast Guard notifications as unknown ordnance contact. 2 additional vessels reported damage within the subsequent 18 hours. One a Singapore-flagged chemical tanker, one a Greek-owned crude carrier operating under Norwegian charter. 4 vessels struck, none sunk. No cargo spill of significant scale confirmed in the initial 72-hour window. By the conventional metrics of maritime incident severity, these were significant but not catastrophic events. Incidents that, in isolation, would have generated elevated insurance premiums, triggered mandatory incident investigations, and produced temporary disruption to affected routes while the security situation was assessed. But they did not occur in isolation. They occurred against the backdrop of an active decapitation strike on the government of the state that controls the northern coastline of the Strait of Hormuz, the confirmed death of Iran's supreme leadership, a command and control blackout across the Iranian military apparatus, and the demonstrated willingness of fragmented Iranian military units, operating without centralized authorization or strategic restraint, to engage commercial vessels as targets of opportunity or retaliation. In that context, 4 struck vessels did not represent 4 incidents. They represented a proof of concept. They demonstrated with the specificity that insurance actuaries require before adjusting risk classifications that commercial vessels transiting or operating in the Persian Gulf were exposed to kinetic threat from actors whose identity, command structure, authorization chain, and targeting logic could not be determined, and therefore could not be priced. The insurance industry's response to unpriceable risk is not a higher premium. The insurance industry's response to unpriceable risk is withdrawal. Lloyd's Joint War Committee convened an emergency session at 07:30 London time on March 2nd. and issued its uninsurability declaration within 90 minutes. The international group of P&I clubs, the 13 mutual insurers that collectively cover approximately 90% of the world's ocean-going tonnage, followed with a parallel notification within 4 hours. By noon London time, the legal infrastructure of commercial maritime trade in the Persian Gulf had been dismantled not by military force, but by the actuarial judgment that the risk environment was no longer amenable to commercial pricing. The Windward data that was circulating through maritime intelligence networks by Monday morning told the story in aggregate numbers whose implications were immediately legible to anyone tracking global energy logistics. Approximately 340 commercial vessels had been in the Persian Gulf, the Strait of Hormuz, or the immediate approaches to the strait at the moment the insurance withdrawal took effect. Of those, roughly 60% were in positions that made immediate diversion to alternative anchorages logistically feasible: the Gulf of Oman, Fujairah anchorage, the waters off Oman's Musandam Peninsula. The remaining 40%, approximately 136 vessels, were in positions that made diversion difficult, costly, or operationally complex given their cargo states, their fuel reserves, their charter party obligations, and the physical constraints of maneuvering very large crude carriers in confined coastal waters under conditions of elevated military activity. Those vessels did not sink, they drifted, holding position, consuming fuel without earning freight, accumulating demurrage costs against charterers who were simultaneously invoking force majeure to avoid liability for the delay, and waiting for a resolution that the commercial system had no mechanism to provide. The daily cost of a drifting VLCC, crew wages, fuel for station keeping, vessel capital cost, and the lost freight revenue of a voyage that is not completing runs between $50,000 and $80,000 per day per vessel. Across 136 vessels in extended holding, the direct cost of commercial shipping immobility was accumulating at a rate of approximately $8 to $11 million per day before any cargo loss, insurance claim, or supply chain disruption cost was factored in. That number is not the economically significant one. It is the visible surface of a cost structure whose most consequential layer is the oil price signal propagating through the global economy in real time. Brent crude's 9% spike to $79 per barrel in the 72 hours following the launch of Operation Epic Fury is a number that requires decomposition to be fully understood. The spot price movement reflects three overlapping signals that the energy futures market was attempting to price simultaneously. The first signal is the immediate supply disruption, the physical reduction in Gulf crude available to the market caused by the tanker immobilization, the loading terminal disruptions at Gulf ports operating under military threat conditions, and the withdrawal of tanker operators from the route. The second signal is the forward supply risk premium, the additional price the market demands to compensate for the probability that the disruption extends beyond the initial crisis window, that Hormuz remains operationally constrained for weeks or months rather than days, and that the alternative supply sources available to replace Gulf crude are insufficient to cover the deficit without sustained price premium. The third signal, and the one that carries the most persistent inflationary implications, is the transportation cost inflation embedded in every energy-dependent supply chain that uses the Persian Gulf as a sourcing corridor. Jet fuel, diesel, industrial heating oil, petrochemical feedstocks, every refined petroleum product whose production chain passes through Gulf crude is repriced when the crude price moves 9%. But the actual cost increase reaching end consumers in the United States and Europe is not 9%. It is 9% multiplied by the energy intensity of every production and logistics step between the crude oil price and the consumer's purchase. A multiplication that the academic literature on energy price pass-through consistently estimates at between 1.5 and 2.5 times the crude price movement for consumer goods with high logistics content. A 9% crude oil spike transmitted through the supply chain at a conservative pass-through multiple of 2 produces an effective input cost increase of approximately 18% for the most energy-intensive consumer goods categories. For the American consumer, that transmission arrives through the most visible and politically sensitive channel available: the retail gasoline price. The relationship between Brent crude prices and U.S. retail gasoline is well documented and mechanically predictable. A $10 per barrel increase in Brent crude, the movement from $72 to the $79 level observed in the first 72 hours, translates into approximately 23 to 25 cents per gallon at the retail pump, with a lag of approximately 3 to 5 weeks for the full pass-through to reach retail prices as existing inventory is sold through at pre-spike procurement costs. The pass-through is not the end of the consumer impact. It is the beginning of a secondary inflation wave that moves through the logistics sector. Diesel fuel costs for trucking, heating oil for residential and commercial heating in cold climate markets, aviation fuel surcharges on passenger and cargo airlines, and eventually reaches every good and service whose delivery depends on energy-intensive transportation. The Federal Reserve Bank of San Francisco's research on energy price pass-through to core inflation estimates that a sustained $10 increase in crude prices adds approximately 0.2 to 0.3 percentage points to the U.S. Consumer Price Index over the following 12 months. If the Hormuz closure scenario extends and crude reaches the $100 level that energy trading desks were warning about by Monday morning, a $28 increase from pre-conflict levels, the implied CPI contribution exceeds half a percentage point of additional annual inflation. In an economy where the Federal Reserve had spent 2 years attempting to return inflation to its 2% target, that contribution is not a rounding error. It is a policy complication of the first order, one that monetary tightening cannot address without simultaneously slowing the domestic economic activity that the conflict's other cost pressures are already suppressing. The third signal from the first 72 hours of Operation Epic Fury, the one that introduces a dimension of economic analysis that energy markets and supply chain models do not capture, is the casualty report from Kuwait. The economic significance of military casualties in a conflict of this type is not limited to the immediate human and fiscal cost of the casualties themselves, however severe the cost is. It is the signal the casualty report sends to the political economy that authorizes and sustains the military operation. The Congressional Budget Office's framework for estimating the long-run fiscal cost of military operations incorporates not only direct operational expenditures, fuel, munitions, equipment, but the multi-decade cost of veteran health care, disability compensation, and the social support infrastructure that sustains military families through extended deployments. The post-2001 conflicts documented by the Brown University Costs of War project demonstrated that the long-run fiscal cost of military casualties exceeds their immediate operational cost by a factor of 5 to 10 when full lifetime care and support obligations are included. But the more immediate economic implication of casualties in a high-visibility operation is their effect on the political sustainability of the operation's cost authorization. The willingness of legislative bodies and populations to continue appropriating the resources that sustain military operations, whose direct financial and human costs are becoming visible in real time. The political economy of military cost authorization is not separate from the macroeconomic analysis of the conflict's consequences. It is the mechanism through which the conflict's duration, and therefore the duration of the supply chain disruptions, insurance withdrawals, and oil price premiums, is determined. An operation that retains broad political authorization can sustain the economic disruptions it generates because the expectation of resolution provides a temporal bound on the market's risk premium calculation. An operation whose political authorization begins eroding under the weight of visible casualties and consumer price impacts generates an uncertainty premium, the additional risk discount that markets apply when the duration and resolution pathway of a conflict cannot be estimated with any confidence. That uncertainty premium does not appear in the $79 Brent price. It appears in the options market's implied volatility surface, in the price of tail risk hedges, and the steepening of the forward curve that reflects the market's judgment that the range of possible outcomes is wide, and the distribution is skewed toward the severe end. The 72-hour snapshot of Operation Epic Fury's economic consequences is, therefore, not a complete picture of what the conflict costs. It is the opening balance of a ledger whose final total will be determined by variables that no market, no model, and no planning framework can currently estimate with confidence. What it does establish, with the precision of 4 struck tankers, 340 stranded vessels, a 9% crude spike, and the first casualty reports from Kuwait, is the financial velocity of the operation's economic consequences. That velocity is not slow, it is not gradual, it is not contained within the geographic boundaries of the conflict. It moves at the speed of insurance market communications, at the speed of futures market price discovery, at the speed of logistics cost recalculation by every supply chain manager at every company whose production or distribution depends on energy priced against Gulf crude. Operation Epic Fury was designed with military precision. Its economic shrapnel recognizes no such precision. It travels in every direction simultaneously, at financial velocity, through every system connected to the global energy architecture. And the damage it inflicts on those systems, on Asian manufacturing margins, on Western consumer prices, on sovereign debt markets, on the commercial insurance infrastructure of maritime trade, does not correlate with the military success or failure of the operation that launched it. It correlates only with the duration of the conditions the operation created. A closed Strait of Hormuz, an uninsurable Persian Gulf, a fragmented Iranian state with no central authority to negotiate with or deter, these are the economic conditions of March 2nd, 2026. They are not priced into $79 crude. They are barely priced into the uncertainty premiums currently embedded in options markets. They will be priced, progressively and painfully, as the duration of those conditions extends beyond the timeframes that initial market reactions assumed. The first 72 hours established the velocity. The weeks and months ahead will establish the distance that velocity carries the economic consequences of Operation Epic Fury into the daily lives of consumers, the balance sheets of companies, and the fiscal positions of governments that had no seat at the table when the operation was authorized. That is the price of Epic Fury, not the price on a futures screen. The price that accumulates in every supply chain, every insurance premium, every consumer invoice, every defense budget, and every sovereign debt market connected to the geography where the operation was launched. 72 hours in, that price is already higher than the markets are showing, and the meter is still running.